Welcome back to the channel. Today we're taking a deep dive into SCHD, one of the most talked about ETFs in the market right now. Whether you're a seasoned investor or just starting out, understanding what's driving its recent performance can help you make smarter decisions with your money. We'll break down recent trends, the top performing companies in the ETF, the sectors that are seeing strong growth, and why investors are shifting away from tech giants toward more traditional companies. By the end of this video, you'll have a clear picture of SCHD's current momentum and what could be next for this fund. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. SCHD has been on an impressive streak lately. Over the past 8 consecutive weeks, this ETF has climbed steadily, now sitting near its all-time high. The reason behind this surge is a broad rotation happening in the market. Investors are moving away from high-growth technology companies and turning toward value-focused traditional companies. This year alone, SCHD has risen roughly 14%, a performance that outpaces both the S&P 500 and the Nasdaq 100. To put that in perspective, the S&P 500 has actually dropped slightly by around 0.33%, while the Nasdaq 100 has fallen about 1.88%. Clearly, the shift toward value stocks is paying off for those holding SCHD. At the same time, many top technology companies that were previously market leaders are facing a tough period. Nvidia, for example, despite being a key player in the AI boom, has seen its stock fall roughly 14% from its peak earlier this year. Other tech giants have also taken hits. Palantir stock has fallen to about $130 down sharply from a previous high of $210. Microsoft has seen a decline as well, dropping from $552 at its all-time high to around $400. Even companies like Adobe, ServiceNow, Intuit, and Salesforce have experienced substantial declines over the past few months. This widespread weakness in tech has been a major driver behind the rotation into traditional dividend-paying stocks, which are seen as safer and more resilient in today's market environment. Investors are increasingly favoring companies that don't rely on emerging technologies like AI. Defense contractors, energy companies, and consumer staples have become the focus. A standout example is Lockheed Martin, which is actually the largest holding in the SCHD ETF. Lockheed Martin has surged to an all-time high of $652, marking a 62% increase from its lowest point in 2025. This rally was largely fueled by political developments, including former President Donald Trump's announcement of a significant increase in defense spending from nearly $1 trillion to $1.5 trillion. The increased budget has directly benefited defense contractors like Lockheed Martin, and investors have taken notice. The semiconductor sector has also seen pockets of growth, even as broader tech struggles. Texas Instruments, another major holding in SCHD, has climbed to about $225. Our previous forecast predicted this move after we spotted a classic inverted head and shoulders pattern forming on its daily chart. Strong demand from companies like Apple and Ford has helped drive Texas Instruments' growth. As more devices, cars, and industrial equipment require advanced chips, this company's sales and revenue continue to benefit. Investors who recognized this trend early have likely seen substantial gains. Telecommunications is another area showing resilience within SCHD. Verizon, the ETF's third largest holding, has risen to about $49 from last year's low of $37. This surge was accelerated by strong quarterly financial results. Verizon reported revenue growth of around 2%, bringing in $36 billion, while its free cash flow increased to $20.1 billion. Strong fundamentals like these are attracting investors who value steady, predictable returns, which makes Verizon a key contributor to SCHD's overall performance. Energy stocks in SCHD have also been performing well. ConocoPhillips and Chevron have posted solid gains over the past few months. Rising crude oil prices are a major factor here, and the trend may continue as geopolitical tensions add pressure to the market. For example, recent statements about potential conflicts involving Iran could push oil prices even higher, benefiting these energy giants further. Energy companies like these are appealing to investors because they combine growth potential with strong dividends, a perfect match for a value-focused ETF like SCHD. Beyond defense, semiconductors, telecom, and energy, several other companies in SCHD are performing exceptionally well. Bristol-Myers Squibb and Merck in the healthcare sector have remained stable and attractive due to steady demand for their products. Consumer staples like Altria and PepsiCo have also delivered solid returns. These companies offer reliable dividend yields and tend to perform well in uncertain markets, which has contributed to SCHD's overall strong performance this year. All of these factors combined show a clear trend. SCHD is thriving because of a market rotation toward value and stability. Investors are moving away from high-flying tech names that are facing volatility and instead focusing on companies with strong balance sheets, reliable earnings, and consistent dividends. This rotation highlights a broader lesson for investors. Market trends can change quickly, and diversification across sectors, like what SCHD offers, can be a smart way to capture growth while managing risk. To summarize, SCHD has had an impressive run recently, climbing for 8 weeks in a row and outperforming major indices. Its success has been driven by a combination of factors: a rotation from tech to value-focused companies, strong performances in defense, energy, semiconductors, telecom, and consumer staples, geopolitical and macroeconomic developments boosting specific sectors, reliable dividend-paying companies attracting investors seeking stability. If this trend continues, SCHD may remain a strong option for investors looking for a balance of growth and safety in their portfolio. It's a reminder that sometimes the steady, traditional companies outperform flashy tech in times of market uncertainty. So, whether you're already invested in SCHD or just considering it, keeping an eye on sector rotations and top-performing holdings can give you a significant advantage in the market. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.